today, which is on PPE. We will continue with where we left. So I would now share the presentation. Right. So I hope you can see the presentation. Is it visible?
Yes, sir.
Right. So last week we started off with the standard LKS 16, and we were looking at the basic concepts, the definitions, and some of the important terms that are used in LKS 16. And then we went on to look at what is an initial recognition and also how to measure it on a subsequent date. So today we are going to look at the depreciation methods. Depreciation methods, the ways and means that the company could depreciate its assets using a scientific method. So why we say scientific method is like there is an underlying formula for you to calculate the depreciation, right? So starting off, the first method that we are going, by the way, there are a lot of methods involved in depreciation, but we are not going to learn all of those methods. We will primarily look at the most used or most widely used 5 methods for this purpose, right? So if you look at the companies around, mostly all of the companies would fit into one of these methods, right? Other than maybe the manufacturing organizations, where it could differ from company to company, right? So starting off, the first method that we have is called the straight line method. We call it as the straight line method. So what does it say? It is a fixed percentage of the original cost of the asset is written off as depreciation in each accounting period. Now, what does this mean is, now you already looked at, when you look at a fixed asset, what is it that you are going to depreciate? So the depreciation is provided on the, I told you, on the depreciable amount. The depreciation is provided on the depreciable amount. So what is the depreciable amount? It is cost less the residual value. It is cost less the residual value. So that is what we call as the depreciable amount. Now, if you really look at this formula here and make the residual value to be 0, where the company doesn't assume any value for the residual value. So if that is the case, then it becomes 0. So which means you are going to depreciate the cost. You are going to depreciate the cost. Now look at the straight line method. What does it say? Straight line method says a fixed percentage of the original cost of the asset is written off as depreciation in each accounting period. So in other words, it is the same thing. We are talking about the annual depreciation, where the cost is apportioned into different accounting periods throughout its life of the asset as depreciation. Now here you apply a fixed percentage. Now what do you mean by fixed percentage? It is going to be your depreciation rate. So in other words, it is the depreciable amount into the depreciation rate. So if you think of an asset which is going to run up to 4 years, what does it mean? Using the straight line method, you will depreciate every year 1/4 of the cost depreciable amount, that is cost minus residual value, right? So the residual value component is actually something coming separately. When we talk about the depreciation, we always talk about depreciation on cost. But you have to remember what you have to depreciate is the depreciable amount. Depreciable amount. So questions may come in various ways. Sometimes they will be silent about the residual value. Sometimes they might say, they might give the residual value, but they say depreciation on cost. So yes, we always depreciate on cost. But what you have to remember is when you say cost, you if there is a residual value given, then you have to consider that also. That is where it is important. You need to be mindful about if there is a residual value, you need to consider that.
So if the residual value is not given, then we don't need to consider that. No, we
Yes,
can
you
take
have
the.
to assume that it is zero. If they are silent about the residual value, then you have to assume that it is zero. Okay.
Okay, so thank you.
Then the second method that we are talking about is called the reducing balance or diminishing balance method, right? So there are various names used, but we have to look at what is the definition. It is again a fixed percentage of the reducing balance of the asset. Now, earlier we said it is the cost. Now we say it is the reducing balance of the asset. Okay. So we need to see what is this reducing balance is. I will explain that when we go into detail of each of these methods. Thirdly, we invent another method which is known as the sum of years digits method. Sum of years digits method. Now this is a mathematical formula that we need to calculate and allocate depreciation based on the formula. So what does it say? It is a combination of straight line and reducing balance. Okay, so when we go into the details, you will see it is a combination of the straight line as well as the reducing balance method. Now, companies may choose different types of methods depending on the type of usage of the assets that they have. But if someone want to have a balance between the straight line method and the reducing balance method, they can opt for the sum of years digits method. The fourth one we learn here is the machine hour rate method. So by the name of it itself, you should recall for what type of organization that you can think of this. Obviously, it is something to do with a manufacturing organization. Why? We calculate the depreciation based on a machine hour rate. You are going to use an indicator or a criteria which is based on the machine hours. That is, in other words, whatever the machines that are working in the organization, in the factory, you will use the number of hours that they are going to work. Okay, so that is going to be the basis of the depreciation method. And then we also have the revaluation method. So generally people do not consider this as a method of depreciating, but there are organizations which can make use of this as a method of depreciation. In other words, what you have to do is you have to do a revaluation every year. Okay, so asset is valued at the beginning and end of the accounting period, and the difference is written off as depreciation. Say for example, you have a building. The building is worth 10 million at the beginning of the year. Okay, and you again go and value it at the end of the year. So by the end of the year, let's say it becomes 9 million. then obviously you have a depreciation of 1 million. But there could be a situation where if you look at the property values always go up. So then you create a revaluation gain, which we will learn shortly after the depreciation methods. Okay. So revaluation method can work vice versa. For assets like properties, land and buildings, it might get appreciated. So you don't get a depreciation. But for any other assets, if you are really doing a revaluation, you can derive a depreciation for those. But what companies do is they do not encourage the revaluation method for assets other than land and buildings. Okay. So if you look at an organization using computers, right, you might use hundreds of computers. Now, if you are going to apply a revaluation method, it is not justifiable. You know why? A computer, as long as you keep on using it, it doesn't appreciate in value. There is always a wear and tear, so it has to depreciate in value. Okay. But then again, it depends on the assumptions that you make for the revaluation. So if the valuer think no, if the computer is going to go up in value, yes, then you have to consider that. So basically, these are some of the important methods, I would say. Straight line method, very common. Reduce imbalance method, very common. Some companies where like trading, partly manufacturing and partly doing trading, they might use sum of years digits method. But if it is fully a manufacturing organization, they will use machine hour rate. So here along with the machine hour rate, you can use labor hour rate also. That is another indicator that you can use. And finally, the revaluation method. Revaluation method. So if you really look at this, let's go into detail of each of these methods now. Right, the straight line method. So when you look at the straight line method, there are advantages and disadvantages. What is the advantage? It is a simple and easy method. It is a simple and easy method. You will see that. I will work out a question, then you will see that it is very straightforward. It is suitable for assets which have a specific effective lifespan, at the end of which the written down value will approach zero. So there are assets where at the end of the time period or the lifetime, the value of the asset will reach to zero. So which means you have fully used it. There is no value left in it for further usage. For those kind of assets, you will use the straight line method. What are the disadvantages? In case the asset is used beyond its effective life, it will be unusual to show the net book value as zero. Say, for example, you have a calculator. Right? I'm just taking an example. You have a calculator. So now this calculator is going to be depreciated using the straight line method. And according to your assumption or the company policy, depreciation policy, your company will depreciate these calculators for a period of 5 years. Let's just assume. So what will happen? Over a period of 5 years, the value of the calculator will reach zero. Why? There will be a cost, let's say 2000 rupees, and over a period of 5 years, you will depreciate and provide 400 each every year. By the time you reach the 5th year, your depreciation and the cost are equal. So what happens? Your net book value will become zero. What do you mean by net book value? Net book value is the carrying amount. Carrying amount becomes zero. So as a result, this may not be a useful method when you are using the asset beyond its useful life. Sometimes calculators may be used for 10 years. So if something like that happens, then there is no point in assuming a depreciation rate of 5 years or using the straight line method. Okay. Then the next disadvantage would be the calculation will not be simple when addition and disposal of assets are involved. Now, if you are using the same asset throughout the period or maybe throughout the lifetime, you can do it. But if there are more and more new additions, and if there are disposals, what do you mean by disposal? You get rid of the asset. Then comes a problem where you will have implications to your calculation. Your calculation might not be easy in terms of uh, the straight line method. Okay. But still for all, people mostly prefer, that is the companies mostly prefer the straight line method, right? Because they know it is very easy to use. So rather than complicating your calculations, you want to make it or keep it very simple in terms of your calculations. So as a result, people might choose the straight line method. The reducing balance method, again, it is very easy to understand and use. It will be suitable for assets which have a lifespan exceeding the expected life. And the depreciation will be high in the initial years compared to later years. You will see that now when we do the calculation. Then again, the disadvantage would be, in order to bring the asset to realistic values, high rates of depreciation need to be used. That is a disadvantage. If you want to reflect the correct value of the asset, then you might have to use artificial rates so that the depreciation calculated is in line with the value of the asset. Lifespan of the assets will be always finite. However, this method implies longer years. So if you look at the lifespan of assets will be always finite. You can't be using it forever. But this method will show you that you are using an asset which has a infinite life. Okay, that is a contradiction of this method. The sum of year digits method is very straightforward. I will show you when we do the calculation, where we will use a mathematical formula. That is what you see here. N divided by 2 into n plus 1. I think you might recall this formula where you have learned maybe when you were doing like O levels or maybe A levels, you might have used this formula, right? This is a simple summation formula that you use in series, where this number n refers to the life of the useful life, number of useful life of the asset. The disadvantage will be, you will see that we will be using some weights to calculate the depreciation. It may not reflect the correct depreciation applicable for the asset. But overall, it will be equal. But over the life of the asset, it might not reflect the correct amount of depreciation if you are really worried about the carrying amount of the asset. Machine hour rate. At the end of the total number of machine hours, the written down value will become 0. That is your assumption, and this method will give you to take you to that particular position. Depreciation is linked to the output attained. I will explain when we do the question, so you will understand. Disadvantage would be the depreciation could be calculated only when the event has occurred. Suitable mostly for machinery. So I will just come back to this disadvantage when we do the calculation. Okay, right. So what are we going to do now is we are going to look at each of these methods and try to do the questions under each of these methods, right? Okay. Starting off with the straight line method. Starting off with the straight line method, right? What does this straight line method say? Read the question for yourself. First, read the question. ABC company purchased furniture for 400,000 on 2nd April 2015. The expected lifespan is 8 years, after which it is assumed to have a 0 salvage value. So what do you mean by salvage here? What do you mean by salvage?
Residual value.
Residual value. So it is given. The residual value is going to be 0. They want you to calculate the depreciation, that is annual depreciation, and also the accumulated depreciation as at 31st December 2017. So first, when we are doing the question of this kind, we need to take down the information that is given to us. The information that is given to us. Right. So you can look at the board. Right. Hope the board is visible to you. Is it visible?
Yes, sir.
Right. So first we take down the piece of information that is available on the question. I hope you have the handout with you. So the cost is given as 400,000 and you have the date of purchase. I will use it with the short form. Date of purchase, that is DOP, where they say 2nd of April 2015. And they say the residual value is 0. Residual value is 0, and they have a useful life of 8 years. Useful life of 8 years. So the question is, what is the annual depreciation and the accumulated depreciation? Annual depreciation and the accumulated depreciation, ACD. I'm using some short forms. Right. Now the method that is given to us here is the straight line. Straight line. So what does the straight line method definition says? It is a fixed percentage of the cost or the depreciable amount over the life of the asset. Over the life of the asset. So you know the annual depreciation is equivalent to cost minus residual value into depreciation rate. Am I correct? Can you remember? Is that correct? Annual depreciation is cost minus residual value into the depreciation rate. Okay. Now, what does the definition for straight line method says? It is the cost into a fixed percentage. Cost into a fixed percentage. So we are talking about the same thing. Whatever the annual depreciation that you have as a formula is same as for the straight line method. Straight line method. Cost into the fixed percentage. So the numbers are known. The numbers are known. Cost 400,000 minus residual value 0 into depreciation rate. Now, what is the depreciation rate? What is the depreciation rate? Can somebody tell me?
12.5.
12.5%. That is the calculation that you have to do. In order to make use of the depreciation rate, you need to calculate the depreciation rate using this factor given here. Right? So what is the relationship? Depreciation rate is equivalent to 1 over useful life into 100. Am I correct? So 1 over useful life is 1 over 8 into 100%. You get 12.5%. 12.5. So I apply that 12.5% here. Then what is the answer that I get? I will get how much? 50,000. Am I correct? Am I correct?
Yes, sir.
Yeah.
Right. So did you all understand what is the straight line method is? Under the straight line method, you calculate the annual depreciation, which is a fixed percentage of the cost. Right? So you can interpret it as cost or depreciable amount. We call this as the depreciable amount. Depreciable amount. So depreciable amount, it is a fixed percentage of the depreciable amount. Now what is depreciable amount? Cost minus residual value, which is 0. Into, we were required to calculate the depreciation at the rate of 12.5%. 12.5%. So this 12.5% is, how will you calculate it? 1 upon useful life into 100%. So 1 upon useful life is 1 upon 8 into 100%, which will give you the 12.5%. So when I apply that 12.5% on 400,000, I get 50,000. Right? So you can take down this for the first part of your question, that is to calculate the annual depreciation. Quickly take down. By the way, I want you all to do it rather than taking a photograph. Because if you don't write and do it, you will not remember. So better take your exercise books and write the steps. That is very important. First, you have to read the question and take the inputs from the question. Even you can practice this in your examination hall as well. take the important details into a summary like this. Write it on the answer book at the examination. Then calculate whatever that is required, like in the case of depreciation rate, and then go to the question. Okay. Now we go into the second part of the question, which is the accumulated depreciation. The accumulated depreciation. Okay, so now we have calculated how much the depreciation will be for one particular year, one financial year, right? Okay. Now let's go to the accumulated depreciation calculation. Now for this, I will call for a timeline of the asset. I call this as the timeline of the asset. So please follow this. It will be easy for you all to understand, right? So here I start with time equals 0, right? Now what is time equals 0? That is the day on which I purchased my asset. So 2nd April 2015 is the date of purchase. That is my time equal 0, right? But the question here asks about the accumulated depreciation as at 31/12/2017. 31/12/2017. Right. Now, the asset was purchased on 2015, but we are talking about a depreciation in the year of 2017, which is known as the accumulated depreciation. So what do you mean by this is how much of depreciation that you would have provided on this particular asset from this date to this date. Now what we calculated is only for one particular year. But you know, from here to here, it's not one financial year. Okay, right. Now tell me, what is the financial year of this company? What is the financial year of this company? Anyone? What is the financial year of this company? Did you all get my question? How do you determine the financial year of a company? I got one answer in the chat box. Let's see. 1st April 2015 to 31st March 2016. That is incorrect.
No, sir. 1st January to 31st December, sir.
Very good. How did you determine that?
No, it says that accumulated depreciation has to be calculated as
Yes.
of 31st 12.
Yes. So this is the indication of the financial year. Now these things will not be given straightforward to you in examination. Okay. So that's why I'm asking that question from you all. You have to think about those and pick it from the question. So as far as this question is talking about an accumulated depreciation for 31st December 2017, which means the company's financial year is from January to December. From 1st of January to 31st December. Right. Now, let's talk about this timeline of this asset. Timeline of this asset. Now, what is happening here? if this company's financial year is from 1st of January to 31st December, you are going and purchasing an asset in the month of 2nd April 2015. So if you really look at the financial year of this company for the year 2015, which we call it as T equal 1, will be 31st December 2015. Do you all understand that? Isn't it? This asset is purchased during the financial year of 2015. Now we are talking about the year of 2015. So this is the entire 2015, which is from 1/1/2015 to 31/12/2015. But what is happening with this asset? They are purchasing this asset after a period of 3 months. So you are purchasing it somewhere in April. That will become the time equals 0, means the starting point of this asset. The starting point of this asset. Right. So when you look at this particular financial year, you will end the financial year 31/12/2015, which becomes your first financial year. I will call it as FY1. FY1. Right? Then you go to the second financial year. That is 1/1/2016 to 31/12/2016. Am I correct? So that becomes your second financial year, FY2. FY2. But the question is referring to a financial year of 2017. So I will go to my next one also. T equal 3, 31/12, which is my right. Do you all understand up to that? If you have a question, you have to ask, because it is the same principle which is going to apply throughout for other questions as well and other methods as well. So you need to be very clear on this. How do I determine the financial year? Depending on the financial year, how do I break the time periods? This asset has been purchased in the middle, or I would rather say somewhere in between the year. So my first financial year would be the year ending 31st December 2015. Then I go to the next financial year, and then I go to the next financial year. So there are 3 timelines, 3 time buckets, right? So this would be my depreciation 1. This I would call as depreciation 2. This I would call as depreciation 3. What does it mean? My annual depreciation 1, annual depreciation 2, annual depreciation 3. So my accumulated depreciation as at 31/12/2017 would be D1 plus D2 plus D3. D1 plus D2 plus D3. What do you mean by that? Annual depreciation, I call it as annual depreciation, right? Then it will be easy for you. Annual depreciation 1, annual depreciation 2, and annual depreciation 3. Annual depreciation you have already calculated. How much is it? 50,000 per year. 50,000 plus 50,000 plus 50,000, which will give you 150. Is that clear with you all? If you have a question, please ask. Because this needs to be understood thoroughly.
Sir, I have a question.
Yes.
Now the financial year is from 1st Jan to 31st December. In this case, now the asset was purchased on 2nd April.
Okay.
So not in between. So now in this case, now are we going to proportionately calculate for the first year? Not like that. No, sir. That is for the full year.
No, we don't proportionately calculate it. Right? I'll come to that point. That is the next step that I'm going to discuss. But it is a very valid question, very important question. That is, now I think other students also would have understood the question. Now we are talking about a financial year which is not 12 months, because this asset has been purchased in 2nd April 2015. So if you look at the 2015 financial year, this asset has been used only for 9 months. Am I correct? This asset, relatively, it has been used only for 9 months, because January, February, March, the asset was not there. We are bringing in the asset only on 2nd April. Let's say it was 1st April. Okay. So if that is the case, you have used the asset only for 9 months in that particular year. But you are making a depreciation of for 12 months, because my annual depreciation means it is for 12 months. Right? So her question is very much valid. Why we are depreciating it for 12 months, whereas I have used it for only 9 months. Now, what is the answer that others can give? Can somebody explain or give you an answer to that question? Now, she is asking a question, why we are depreciating it for 12 months instead of 9 months, because the asset has been used only for 9 months in that year. So why are you considering 50,000? That is that valid question that she is raising. Can somebody answer that question, please?
So is it because the straight line method is to calculate? Now, as per the straight line, we calculate the fixed percentage of the original cost. Is that the reason, sir?
No.
A good concept?
What is it?
A good concept?
Accrual concept is there, but it does not directly relate to this. There is a specific answer for this.
The company policy?
Very good. Very good. Can you go on to explain what it is? How it will have an impact?
So year of acquisition is the full year's depreciation?
Yes. Now that's what we spoke about under the depreciation policy, right? Now, in companies, the company has to specially mention about their depreciation policy, right? So in their depreciation, I wanted you all to go through the depreciation policies. Did you all go through? I wanted you all to go through the notes of different financial notes of different companies to see what it is. Did you all look at it? No, I believe. Okay, you all have to do it. When I say something, it is a piece of information for you. So you have to go and refer those. Anyway, so when you look at the company's policy with regard to depreciation, the company has to specify what is the method. So here, the company is using the straight line method. Okay. But the company is silent about how it is going to apply the straight line method. Okay. So that is where the company's depreciation policy becomes very, very important. That is because why this question has come now. One student raised a valid question, why you are depreciating it for 12 months when the company has used only for 9 months in the first financial year. The question doesn't arrive in the second and third year because it is fully 12 months. Right. So the answer for that question is where it has to be put down in the company's policy on depreciation. Policy on depreciation. That is where the policy of a company, depreciation policy of a company is very, very important, especially in the case of fixed assets. Okay, right. Let us make a note here and then I'll go into detail about answering your question. Okay, so please take down. When depreciating fixed assets, the depreciation policy of the company, plays an important role. Next line. In this policy only, the company will specify the useful life, or the depreciation rate, comma, depreciation method, comma, application of the method, etc. Next line. In this scenario, that is relating to this question, in this scenario, the company policy is silent. With regard to the application of the depreciation method. Therefore, Therefore, the depreciation in the year of purchase in the year of purchase and maybe in the year of disposal would be applicable on prorate basis on prorate basis. Okay, so what are we saying here? If a company is to define its policy, the depreciation policy, it has to be mindful about few things. What are the few things? How it will depreciate, that is the method that it will use, whether it is straight line or reducing balance or sum of digits or machine hour rate, whatever. You have to specify the method that you are going to use. Secondly, you should definitely have the useful life in terms of number of years or in terms of the depreciation rate. One of the two should be there. Then, very, very important is how you apply this method for depreciation in the year of purchase and maybe in the year of disposal. Because in between there won't be an issue. Here you have 12 months, here you have 12 months. So according to the principles, you talk about an annual depreciation. But when it comes to the year of purchase and maybe in the year of disposal, now this asset is going to go on like this. Now T3, T4, T5, T6, likewise it will go because it has 8 years. Or sometimes what will happen? Maybe in T5, somewhere in the middle, they might decide to dispose. So the question is, how should I apply the depreciation method in the year of purchase and in the year of disposal? That is the question. So the policy has to clearly specify this in the policy. What is the method that I should apply in the depreciation calculation? If the policy is silent, then I need to apply the prorate convention. Very, very important. You have to remember. Even in exam questions, you have to read the question very carefully. If the policy doesn't talk about how you will depreciate for the year of purchase and for the year of disposal, then you have to assume I will calculate it on prorate basis. That is an assumption that you have to make. Now, if that is the case, now let's look at this question. What happened here? They spoke about the method, straight line. They gave us the useful life that is given, but they were silent about what do we do with the depreciation in the year of purchase. Since they were silent, we are going to use the prorate convention. The prorate convention. Am I clear? Am I clear up to that point? So you have to be very careful with regard to the depreciation when you are calculating the depreciation for the asset in the year of purchase and maybe in the year of disposal. And maybe in the year of disposal. If they are silent about it, then I have to apply the prorate convention. Okay, right. So I hope that you would have taken down this initially. If you have not done, I will just give you few seconds. Actually, this should come prior to the paragraph that we wrote now. Okay, or maybe you can take down this, then I will give a small note and then we will do the answer again. If you have not taken down this, quickly take down this accumulated depreciation calculation. Okay, below that you can take down. Since the policy was silent, since the company policy is silent in the above question, the annual depreciation in the year of purchase, would be calculated using the prorate convention. Right? So now look how it is going to be. AD1, that is the year of purchase. Now we know for a complete financial year, the depreciation was 50,000. But here the company has purchased it only in April. Don't go into the details of number of days when you are doing questions. Go on the basis of the month. Okay? So you consider the month that it was purchased. So this has been purchased in April. From April to December, there had been 9 months. Am I correct? There had been 9 months. So the depreciation that you calculated for the 12 months was 50,000. What do you mean by prorate convention is you have to depreciate only for the period that you have used it or from the date of the purchase. So the AD1 would be 50,000 into 9 divided by 12. Right? The balance 2 will have the 50,000 each. Because there it was 12 months each. The T2 here 12 months, here also 12 months. So there won't be any problem. There it will be 50 plus 50. Here is the problem. Because it was only in existence for 9 months. 3 months were not there. So now when you calculate it, I think it will be 137,500, is it?
37,500.
Okay. Right. So now I think you would have understood, and I have answered the question that you raised. Why did we calculate the depreciation for 12 months? Right? So now it is calculated only for 9 months. But why did we do it? Because the company policy was silent and I had to use the prorate convention. Right? So generally in companies what they do is they specify this. They say depreciation is calculated on prorate basis or using the prorate convention. If they are silent, which means that we have to use that prorate convention. If there is an alternative, then they will have to specify. They will have to specify. So I hope this is clear to you all under the straight line method. Under the straight line method. Okay. Right. So before we move on to the next method, right. So I'm just trying to show you a question that has come in September 2016, long time ago, around 5 years back, right? So let's look at this question and then we will continue with the rest of the methods, right? Okay. Look at this question. The following information is extracted from the books and records of Saubhagya Bank, right? Machinery was purchased on 1/1/2012 with an initial cost of rupees 100,000. And it was sold on 30th June 2015 for rupees 70,000. Okay, they have sold it. The depreciation policy, you see, the question talks about the depreciation policy of the company. The depreciation policy of the bank is to charge full depreciation for the year of purchase and no depreciation for the year of sale. Do you understand that terminology? the depreciation policy of the bank is to charge full depreciation for the year of purchase and no depreciation for the year of sale, right? So I didn't want to do that question now because we have to learn some more and then only we have to come to that question. But let's look at what we have been looking at so far, right? Now, if you go and apply the same theory here for this question, where they say full year depreciation in the year of purchase and no depreciation in the year of disposal. Now, what would happen? What would be the answer? If you apply that policy to this particular question, what would be your accumulated depreciation as at 31st December 2017? What do you think?
150,000.
150,000. Any other answers? I hope the question is clear to you all. Now, what I'm doing is I'm going back to the question that we did, right? Now, I'm going to give you the policy of the company. Now, the policy of the company is changing. Let's say this company is going to depreciate, his company is going to provide full year depreciation in the year of purchase and no depreciation in the year of disposal. If that is the case, what would be the accumulated depreciation as at 31st December 2017? What is the answer? I've got one answer, which is 150,000.
100,000. 100,000.
Pardon?
100,000.
100,000. Why is that? Why do you say 100,000?
Because so it says no, in the year of purchase there is full depreciation and no depreciation for the year of sale.
Yeah, so now year of sale we have not come there. Now that is T5, right? T5 is somewhere later. We are not bothered about it. Now we are talking at up to 31st December 2017. So the policy says in the year of purchase, irrespective of whether you use it for 1 month or 2 months or 9 months, I don't mind. You depreciate it for 12 months. So what does it mean? It means I don't consider whether it is 9 months or 12 months or whatever. Whatever it is, I'm going to use the annual depreciation. So my annual depreciation is 50,000. So even for AD1, I will use the 50,000. So that is what we initially did. Prior to this, that is what we did. Okay? Did you get it? Prior to doing this, before applying the prorate convention, what we did initially was we calculated 50,000, 50,000, 50,000, and we took the total, which is 150,000. So that is correct when the policy is where full depreciation in the year of purchase and no depreciation in the year of disposal. No depreciation in the year of disposal. Okay? That is one situation. Now I am going to give you another question. Take down. Right? It is again on the same thing. Huh? You are not looking at a different question. It is on the same thing. Forget about that September 2016. That we will do later. Right. Under the same question, now after doing this, I am going to give you another point. Right? Take down. Suppose if the company adopts a policy adopts a policy to provide full year depreciation in the year of disposal and no depreciation in the year of purchase. And no depreciation in the year of purchase. Full stop. What would be the accumulated depreciation? As at 31/12/2017? As at 31/12/2017. Right? So now I am giving you a different policy. Now what is the answer? Let's see. Yes, I have got one answer. One person says 100,000. Are there any other answers? 150, 100,000. I'm getting different answers. What do you think? What would be the answer?
So accumulated depreciation as at which date, sir? 31st?
17. We are sticking to the same. 31st December 2020.
Okay, sir.
I'm not changing the original question. It's only the policy that I'm changing. What would be the answer? We got another answer. Let's see. Yes. So most of you say 100,000, which is the correct answer. So what is the change that I do? I said full year depreciation in the year of disposal. At the time of selling the asset, maybe you might sell it in the middle of the year, or at the beginning of the year, or maybe towards the last part of the year. I don't mind. In the year of disposal, you need to provide a full year depreciation. But in the year of purchase, no depreciation. In the year of purchase, no depreciation. So what will happen automatically? AD1 cancels. AD1 cancels. So automatically, you will have only this. AD2 and AD3. Is that clear to you all? Because this is very, very important. This basic knowledge about application of the policy is very, very important. That is something that you can go wrong in the examination. So that's why I'm spending a little bit of time in this, so that everybody is in par and in the same line, where we all understand what is this depreciation policy versus prorate convention. So if they don't talk about the policy at all, whether to depreciate full in the year of purchase or in the year of disposal, nothing is given. So I will stick to the prorate convention. So even in examination, you can say, in the absence of the company's depreciation policy, it is assumed that depreciation provided on prorate convention. Even without writing it, no problem. Even if you don't write it, it is not a problem. But suppose if you remember, you can put it down and do it. No issue. Okay. So I hope everybody is clear with this. Application of the prorate convention and when to not to apply the prorate convention. So you have only two options. If the policy specifically says year of purchase what to do, year of disposal what to do, then it's very clear. If they have not given, or if they say it is prorate, have to use the prorate convention. Okay, right. I hope it's clear. Let's now look at the second question, that is under straight line method. Straight line method. So if you really look at it, this is what the depreciation policy of the company is. I don't know whether you can see that. This part here, right? You look at it, depreciation is calculated. I hope you can see that. Is it visible to you all?
Yes, sir. Yes.
Right, where it says depreciation is calculated to write off the cost of the items of property, plant and equipment, less their estimated residual values. Okay, you see how the policy is drafted using the straight line method. Using the straight line method over their estimated useful lives. You see? So they don't talk about whether how you do it in the year of purchase or how you do it in the year of disposal, which means it is on prorate convention. Okay, and you see how the depreciation rates are. Freehold and leasehold buildings, it's at 40 years. Motor vehicles 5 years. Computer equipment 5 years. And all other office furniture and other, you have 5 years. Furniture and fittings for 10 years, and machinery and equipment for 10 years. Okay, so this is what I wanted you all to check from the different companies, how the depreciation policy of theirs look like. Okay, so you can find it under notes to the financial statements. You will have the policy given, depreciation policy of the company. Okay, so you can refer looking at the different companies. Right, let's go to the second part of the question, that is the next method, the reducing balance method. The reducing balance method. So just go through the question and take down the key points as we did in the previous question. So the company, the cost is 600,000 and the date of purchase is 1/5/2014. Right, and they are assuming a depreciation rate of 20%. Then calculate the depreciation for every year. Please note and underline the question properly. Calculate the depreciation for every year. They are not referring to the annual depreciation here. Calculate the depreciation for every year up to 31/12/2017 and calculate the accumulated depreciation as at 31/12/2017. So it's very obvious that the company policy is silent. So we need to apply the what? What do we need to apply?
Prorate.
Prorate convention. Yes, very good. Prorate convention has to be applied. So what is the residual value of this asset? What is the residual value of this asset?
So 0.
It's 0. If you are not given, you have to assume it as 0. Okay? As long as the information is not given, you don't have to worry. Assume it as 0. Right. Let's go to the board now. Okay. So I have taken down the information. Cost 600,000. Date of purchase 1st of May. Depreciation rate 20%. Residual value 0. They want us to calculate the annual depreciation for every year. Right? And the accumulated depreciation up to 31st December 2017. Right. So let's look at the timeline now. So the time is 0 when the asset is purchased, which is 1/5/2014. And the question talks about 31st December 2017, which means the company's financial year closes on 31st December of every year. Okay, so we are supposed to go up to T4. We are supposed to go up to T4 because the asset has been purchased in 2014. So we are looking at from 14 to 2017. So we have financial year 1, financial year 2, financial year 3, financial year 4. And here we are given the method is reducing balance. You have to remember that. Reducing balance, right? Reducing balance is the problem. That is what we have to now look at, right? So we have to apply the prorate convention, which means what is the time period during the first year? So first year, if you see really from 1st May to 31st December, it's only 8 months. Am I correct? So what you have to do is you have to calculate the depreciation for 12 months and then you have to work it out for 8 months. Work it out for 8 months. Now the problem here will be, let's say, we assume that this is annual depreciation 1, AD2, AD3, AD4. Right? Now, according to your knowledge so far, whatever that you have learned, AD1, if you calculate, it is annual depreciation. So what it is? Cost minus residual value into the depreciation rate. Into the depreciation rate. So cost is 600, residual value 0 into depreciation rate 20%. This will give you the depreciation for 12 months. But what I need is only for 8 months. So what is AD1? Can you quickly calculate? How much is it?
So 80,000.
How much?
80,000.
8,000?
80,000.
80,000. Because we are talking about 5 years, so it is 120 and it will be 80,000 rupees. Okay, do you understand? Annual depreciation for the first year, if you simply look at per year, it will be 120,000. Why? Depreciation rate is 20%, which means 5 years. So if you depreciate 600,000 over 5 years, it will be 120,000. So 120,000 is for 12 months. How much is it for 8 months? Very straightforward, right? Without even writing anything, without any calculators, we should be able to calculate, right? So I want you to take up to this. Please write down, because thereafter only the complications come. Okay, right. Now comes the problem. Now, according to the reducing balance method, if you go back to the particular slide where you had the 5 methods, it said the depreciation has to be calculated on the reducing balance. On the reducing balance. So please do follow this, very, very important. Now, when it comes to the first year, you have simply calculated it. No issue. But when you go to the second year, I'm just raising this. The theory comes into the play. That is, AD2 will be equivalent to not the traditional cost minus residual value into the depreciation rate. They talk about something known as the net book value into the depreciation rate. What do you mean by this net book value? That is known as the reducing balance. That is known as the reducing balance. Okay. So what happens when you go to the subsequent years? The first year there won't be issue. It's same as what we do normally. But when you go to the second year, what they say is it is actually calculated based on the reduced balance. Reduced balance, that is the net book value. Now, what do you mean by reduced balance? Please follow this, very, very important. When you purchase this asset, it had 600,000. Am I correct? When you purchase this asset, it had 600,000. You all can see this, right? What I have written?
Yes, sir.
Right. Now, when you go to T equals 1, that is, you start using this asset, you reach T equals 1. When you reach T equals 1, what have you actually done? You have depreciated for a particular year. Of course, in the case of this, it is only 8 months, but then again, you have depreciated. How much was the depreciation? 80,000.
80,000.
Right. Now what they say is when you reach this T equals 1, that is 31st December 2014, your asset is not 600,000 now. If you are using the reducing balance, it is now 600,000 minus 80,000. Do you understand that? When you reach your first end of the first financial year, your net book value or the reducing balance is 600,000 minus 80,000. So on that balance only, you are going to apply the 20%. This is what called depreciation, calculating depreciation under reducing balance. Reducing balance. So we actually call this as point net book value 1. Here it is net book value 2. Here it is net book value 3. Here it is net book value 4. So when you go to the second financial year, that is AD2, if you are to calculate AD2, what you have to do is you have to take NBV1 and apply the depreciation rate. Always remember, the the annual depreciation for the second year would be the net book value at the end of the first year into the depreciation rate. So the net book value at the end of the year is 600,000, which is the cost minus my depreciation for the first year, 80,000. So when I calculate this, how much is it? 520,000
520,000.
into 20% means 104,000, is it?
Yes, sir.
104,000. 104,000. So AD1 was 80, but when you go to AD2, it is 104,000. 104,000. Now let's try to calculate AD3. That's why they have specifically mentioned calculate the depreciation for every year, because year on year it is going to change. Why? The net book value is going to change. So AD3 will be equivalent to net book value 2 into depreciation. Okay, net book value 2 into depreciation rate. So what do you mean by net book value 2? That is, net book value 1 is 520,000 minus the depreciation for the second year into 20%.
So is it 520,000 minus 104,000?
Yes. Because when I reach this point, my cost is the net book value is 520, right? What is 82? 82 is 104,000. So when I go to here again, from that 520,000, another 104,000 is to go out. That is what I have written. Okay. So 520 minus 104 into 20%. How much is that?
83,200.
83,200. Correct? 83,200. So similarly, you can calculate AD4 also. AD4 would be NBV3 into DR. That is, now 520 minus 104,000 is how much? 416, is it? Correct?
Yes, sir.
Minus 83,200 into 20%. How much is that?
66,560.
66, 560.
60.
16 or 60?
60, sir.
Right. So we have calculated all the depreciations. That is 81, 82, 83, and 84. By the way, this is under reducing balance method. Now, what is the difference compared to the straight line? Here, the balance on which we are going to apply the depreciation rate is going to go down. Under the straight line method, you always apply the fixed percentage on the cost. Can you remember? It was always the cost. But here, year on year, it is going to reduce. How much? By the annual depreciation amount. So when you go to the end of the first year, cost minus the depreciation that you provided for the previous year. That's why we got 104,000. When you go to the second year, the next year, the net book value will be the net book value of the previous year end minus the depreciation that you had. So likewise, it will come. Yes, I think there is a question. You can ask. Who is that? Isuru? You can ask the question. You want to ask something?
Sir, third one answer is 66,560. Is it correct, sir?
Okay, hold on. I'll calculate it. 416 minus 83,200. So you get 332,800 into 20%. Yeah, 66,560. Correct.
Yes, sir, that is correct.
Right? So we have answered the first part. First part is calculate the depreciation for every year. First year 80,000, second year 104, third year 83,200, fourth year 66,560. Right? Now leaving out the first year because that is only 8 months now. Keep it aside. The remaining depreciation, what can you say? What can you say?
So it's reducing.
It's reducing. So the name itself gives you the meaning. The depreciation will be reducing year by year. Okay? The depreciation will be reducing year by year. In other words, I can put it like this. The depreciation will be higher at the beginning of the year. When you go on, it will come down. But what is very, very important here is it will not reach zero. It will not reach zero. So that's the point that I want to highlight. If you really look at the slide that I was talking about, reducing balance method, look, the depreciation under the disadvantages where it says lifespan of the asset will be always finite. However, this method implies longer years. So Under this method, you will keep on depreciating. It will not be zero. You will not reach zero. You can continue. If you want to calculate, you can calculate AD5, AD6, AD7. It will continue. So, but we say the company policy is to depreciate it over 5 years because it is 20%. So when you depreciate it for 20%, at some after the period of 5 years, it should reach zero. Whereas in this case, it won't reach zero. Okay, so that is a disadvantage. In the case of straight line method, if you say up to 5 years, after 5 years, it will be zero. And more than that, under the straight line method, every year, the depreciation amount will be same. But here, it will be different from 1 year to another. Okay, right. So let us now try to summarize the calculation that we did. Okay, under the reducing balance method, let's try to put it on a table. Okay, I'll just have the numbers written somewhere. 80, 104, 83,200, 66,560. Right. Now the same calculation, I'm going to do it in a different manner. Okay. Right. This might sound a little bit easy for you all. Right. Here, $14, 15, 16. Okay, right. So I would say opening balance, depreciation, and closing balance. And closing balance. Okay, right. Now see how I'm going to simplify the calculation that we were taking long hours and do it. Right. Opening balance means as at 31st December 2014, when you look at this asset, it was 600,000. 600,000, right? But for the first year, that is 31/12/2014, ended year, you had to depreciate this asset for 8 months. Can you remember? You have to depreciate it for 8 months. So 120 was the depreciation for the full year, but since it was what you can do is you can calculate the depreciation and put it. So I'll just do it here. D1 would be 600,000 into 20% into 8 divided by 12. So you got 80,000. Right. Now that 80,000 comes here. Okay. Now what is closing balance? Closing balance means the net book value. So cost minus depreciation will give you 520. Now this 520 will be the opening balance in the next year. Right? So now what is this? This is actually the net book value. So you calculate the 20% on this 520, which is 104. So you get 416. Then the 416 comes here. You calculate 20% on this. 83,200. 83,200. How much is that? 332,800. That comes here. 66,560. So you can deduct this and put it here. Now, what is the question? What is the accumulated depreciation? You take the total of all these, that will be your accumulated depreciation.
So excuse me, the board is not that clear. If you can just read the column in the what you have written in each and every
Okay.
column, sir.
So what I say here is year. This will be the opening balance. Opening balance means at the beginning of the year, what will be the balance? Right? Here I said depreciation to be calculated 20%. And this is the closing balance, which is the net book value. Right? So when you calculate the depreciation for the first financial year, the balance will be 600,000. Right? That is the opening balance because there is no residual value, so 600,000. Into when you apply the 20%, but remember that is for only 8 months. This is for 8 months. You have to remember that. So 8 months, because of that only you get 80,000. Cost minus depreciation give you 520. Then the 520 comes as the opening balance for the next year. Because I am using the reducing balance. Reducing balance. So 520 into 20%, I get 104. Then likewise, what do you think about this method? I think this is much more easier, right? Doing it on a table. No response for that. Why is that?
Yes, sir.
Both the methods are difficult, is it? So suppose if this question they ask you, what is the accumulated depreciation up to 31st December 2015? What do? You add only these two. That is 80 and 104. If they ask up to 2016, you add all three. So likewise, you can continue. So for an examination perspective, I would suggest if you can go to this, it will be very easy because it's very clear. You will not make a mistake because otherwise you have to do individual calculations for each and every. Here, you have the number in table, apply 20%. So that is only the calculation that you have to do without repeating the numbers again. Okay. So we have reached 5:30. So what I would suggest is please do a revision of both the methods, straight line and the reducing balance. If you have any questions, you can always ask next week when we start. And next week I would expect to complete LKS 16. And probably I would start with the next topic. I have already shared the handouts. I don't know whether you saw it. There were two handouts. One is on the miscellaneous standards that we have to go through. Just quickly, let me check whether we have the handouts. Beyond week 16. Yes. Yes. I think you would have received two handouts this week. Is that?
Yes, sir.
Right. Now, my announcement would be that one of the handouts will be captioned as regulations to banks. That is handout number 14, chapter 14. Now, this chapter 14 is totally reading material. Okay. So something that you have to read. Then maybe towards the last part of our course, I would just run through this because we will not have time to go through one by one each of these, and mostly these will be like theoretical part of your paper. Okay, so you would observe that these whatever the topics that are covered in this normally comes in as a essay type question for 20 marks totally on this theory, right? So that is what I have given. So you have to start reading this, and probably I won't normally say memorize it, but you have to remember this. So either you have to memorize it, or some way of the other you have to remember these topics. That is very, very important, right? Then the other handout is on the miscellaneous standards that we need to cover. So that we will do, right? So next week the plan is that I will do the standard, that is this particular standard, and then LK16, once we complete it, we will go to the miscellaneous standards. Then thereafter we have 3 more topics to cover, right? That is financial ratios. Then we have the bigger standard, financial instruments. Then the last standard that we have to cover, that is statement of cash flows, which is on LKS 7, right? With that, we complete the course. So my message is that we are almost nearing towards the end of our course. So start revising, plus go through all what we have learned. If you have any questions, you can always ask that in the class. There is a question, sir, is there any formula to get the accumulated depreciation directly without CAD? No, there is no formula where you can get the accumulated depreciation directly unless it is a straight line method, right? For reducing balance, you won't get it. There is a complicated formula, but I don't want to discuss it because even this manual method you might find difficult. So for reducing balance, there is no, right? So let us go on this basis. What you need to remember is the difference between the straight line and the reducing balance. The straight line method, the depreciation will be always equal every year, other than the first year or maybe the last year. But in the case of reducing balance, every year the difference, the depreciation will be different due to the use of the reducing balance or the net book value. Okay, so what I would suggest is like I'm planning to have a class on the holiday that is coming up. I can't remember the date, whether it is 19th, not the POE day, the other one. Can we have a class on that day? Is it okay to have? I need to discuss it with the IBSL also. So let me tell you all later. But I'm planning to have one probably on one of those 2 days. Okay. So please be prepared. By that time, you should have covered almost all the topics except for the 3 more topics that we need to go. Okay. So start looking at the past papers, whatever the areas that we have already covered, you can start.
At what time?
Sorry?
At what time?
Probably maybe in the afternoon. I'll let you know because I need to discuss with the IBS officer also. I will come back to you all on that. Maybe next Saturday I would tell you all. Okay? Right.
So we don't have exams, so anyway this year it will be maybe in Jan, no, sir?
Probably I would say. I'm not sure because if the schools reopen, and probably we might have it in December. If they permit, like right now, still not all the schools are open. So because now to conduct exams also you need availability now. So probably December or in January. Okay. Right. Okay. Stay safe. Meet you all next week.
Thank you, sir.